The economy is slowing. That's our topic for today's Backstage Pass. The first estimate of Q2 gross domestic product came out today, and that showed that GDP for Q2 decreased by 0.9%. It was forecasted that it would increase by 0.5%, went the other way, and that makes two GDP readings in a row that are negative. Q1 was negative 1.6%, Q2 coming in this morning at negative 0.9%. Now, by most economist standards, two negative GDP readings in a row means that we're in a recession. And yesterday, Fed Chairman Powell mentioned the fact that we are seeing a slowing economy. Now, that was before the GDP reading, but the data was already starting to show that the economy is slowing down. The Fed did raise their overnight rate by 75 basis points yesterday. That was kind of expected. And then Mr. Powell went on and discussed some things, including the jobs market, the slowing economy. He did mention that the jobs market is remaining very, very tight. As a matter of fact, unemployment rate is still at about 3.6%, still very, very low. Initial jobless claims came out today. They decreased a little bit week over week, but we're still higher than estimates. And so, what does all this mean for the markets? Okay, so stock market and bond markets are both reacting, obviously, but are reacting a little bit differently. So yesterday after the Fed meeting, stocks put together a rally, mortgage bonds put together a rally as well and went up. But today, after the GDP reading, there was definitely a divergence. So stock markets, stocks are down this morning, and mortgage bonds are continuing their rally. Mortgage bonds are actually up over 100 basis points over the past 2 days. That's a pretty big move. The 10-year yield is down below its 100-day moving average. That was a floor of support for it. So the 10-year yield is at its lowest level since April. That's the lowest level in 3 months. So the markets are definitely moving in different directions. Now, what does it mean for mortgage rates? Mortgage rates are getting better. Mortgage rates will open better today, and they should continue to get better as the bond market is digesting the fact that, hey, the economy is slowing, inflation should start to creep back down, and so we should see mortgage rates continue to start to come back down. Now, on today specifically, because there were big gains early in the morning, sometimes those gains can get walked back a little bit later in the day. So we could see some repricing for the worse based on today's rate sheet. That should open better, but that's still going to be a better rate than it was yesterday, and it's still going to be better rates than it was 2 days ago. Now look, like I said, most economists' standard of or definition of a recession is 2 negative GDP readings in a row. And I want to make one note. Well, a lot of times what happens in a recession historically is that investors move their money into safe haven investing. And that's good for housing because there's two investment opportunities for investors that are what we would call safe haven. Number one is the bond market. So whenever the recession hits, the economy is shrinking. Typically the stock market starts to shrink a little bit as well, and so investors will move their money into the bond market, which is a very stable, steady rate of return, especially knowing that inflation is starting to come back down. But the other safe haven investment is housing. Investors move their money into housing. Why? Because of appreciation. Now, we saw a 20% appreciation from last year to this year. We don't expect to see that again this year. We expect somewhere around 5%, a little bit more normal, but that's still a great rate of return. And so even though the economy could be heading into a recession right now, we still are very high on the housing market, and we expect to see mortgage rates to continue to come back down, and we expect housing to stay strong. Now that's all the news that we have for today. Remember to stay positive, like, comment, and subscribe. If you have any questions, leave them in the comments. Have a great day, and we'll see you tomorrow.